Hi, welcome to the Reyker product video. I'm here with Chris Hale from the sales team. My name's Sam Mead. So this product's been going about 6 or 7 launches and it's proven really successful, isn't it, Chris?
That's right. This product has been running now for probably just over a year, and there's a reason for that. A lot of the clients that I speak to in general feel that the markets are going to be trading pretty much flat over the course of the next 5 to 6 years. So we've designed a product to fit that criteria. Now, I don't know if you're aware of many products that generate a high yield in this type of environment.
Yeah, I think FTSE 100 income funds are probably offering about 4 to 4.5% at the moment.
Yeah, I mean that's right. You look at our structured product that we've got here, which is dual index based. It is offering almost double that. So you're looking at 8% per annum. So in your scenario there, around about 4% on average. So over the course of 6 years, that's what, 24%? You can generate that kind of yield with this structured product over 3 years. Typically, we feel the European market and the FTSE 100 are correlated quite highly. So the extra risk that's actually being added into this product by pushing in a dual index, in our opinion, is not that great.
I think it's important to add as well, actually, we do monitor competitor offerings, and if we thought this plan was actually getting out of touch with the market, we would change the terms, but it's a testament to how well it's actually been doing over the last 9 months that we haven't really changed much of the features of the plan.
I mean, that's exactly right. When you look at Europe, a lot of people are actually quite sceptical of the market, but if you look at what Draghi's actually doing there, he's really backing it to the hill. And for us, we see value there, and coinciding with the FTSE 100 in this product, it really does add the extra yield to the product. And used as part of a diversified portfolio, it can really boost the yields in your portfolio. So added to bonds, gilts and equities in your portfolio, it really does boost it.
So if actually an investor came up to you, Chris, and they were saying, I've got this structured product here, the regular structured product, and I've got another stock-based income plan, how would you kind of sway them towards our direction?
Well, firstly, you're probably going to get a higher yield of a stock-based income product, let's face facts. But your clients typically are they're looking for less risk because they're trying to generate an income with preserving capital as well. So I kind of throw the question back to you. You're probably aware of the troubles. So say we use BP, Glaxo and Vodafone, for example. There's 3 stocks there, and 2 of those have had problems. So you look at BP, a couple of years ago now, they had a big oil spill. The stock fell off quite a lot. And if you take Glaxo as well, they've only got to run into a patent problem, and realistically, these stocks are going to fall. So at the end of the term, it's important to realise that only one of those stocks has got to have fallen by 50%, and you lose capital. With an indice-based product, you're probably in agreement. You're in a range of stocks and shares across the whole indice. 100 in the FTSE 100 and 50 across the Euro stocks. So the element of risk is reduced. It's still there, but it's reduced. And the fact that you've got 60% European barrier there. Do we really see the market falling off 40% at maturity? I don't know if you do.
No, not particularly, Chris. I think, as well, another thing to mention, like you said, some of those stocks in the actual plans, they're some of the biggest in the FTSE 100, and if someone like BP can actually drop off by that much in a matter of weeks, then it's obviously possible with any stock, really.
That's right, that's exactly right. That's why we choose indice-based products for our income.
Okay, thank you, Chris. Thank you for watching the video. We'll see you soon.